Now for the last segment, we're going to turn to Asia and look at things in a bit different view, and then obviously we'll try to roll in some of the new OPEC data that's come out. Now, before we jump into that again, please like, share, subscribe. Your support is very much appreciated. We try to show things in different lights, use some of those leading indicators and some of those high frequency data points to make our stuff unique. So please watch, and we appreciate the support. So now just looking at some of the South Korean economic data here, you can see that there was a relatively strong increase in mining, manufacturing. When we look at it on a month over month as well as a year over year, that's something that is a net positive. Now, when we look at the net positive, one of the things that we were saying on why that was going to happen at this point was because you did have an increase in exports last month. The problem is imports really kind of underwhelmed. So when you have imports underwhelming, it usually means that things are starting to slow down, and you're going to have exports slow down as well. And it's because when you look at South Korea, they import semi-finished raw materials to create and then export other materials, other products, and you can see that the imports continue to slow. And you did get an increase in manufacturing, but again, it's more about rejuvenating inventories locally, as well as trying to get some of that into the market. Now, exports will remain; they'll bounce a little bit just based on some of the data that we've seen so far. But again, it'll remain under pressure with their biggest counterparts just struggling overall with not only just COVID, just the local purchases on the consumer spending level, which is why, when we look at some of these bellwethers, it's just a great way to kind of get a gauge of, well, what is happening in that global movement of products. And in the EIA show, we cover how there's just been a slowdown in global trade. And that's something where we did get a big spike. You can look at the Chinese bulk index, you can look at a lot of different things, and you can see those increases, but they've really started to roll back now that inventories have caught up with themselves and some of these normalizations. So that manufacturing has gotten, month over month has obviously gotten a little bit better, but it will start to slow down, especially as we go through the remainder of November. Now, again, what gives us confidence about South Korea versus some of the others? I mean, Japan is a perfect example where on a year over year level, they continue to struggle to kind of get back month over month. It's gotten a little bit better. Again, it comes to exports, imports. They continue to see some pressure locally. The retail sales continue to be lackluster as people remain concerned about kind of where things fall out, how COVID continues to impact their lives. And this is going to keep things kind of relatively depressed as we go through and really close out the year. Now, this is just one that we wanted to talk about in terms of the OPEC numbers, because of the estimates, when we look at October, as we start to project going into November. And the bigger issue is going to be what happens next, because as we've talked about in the Frac Spread shows, in the Mediterranean shows, and in the EIA show, Libya continues to go all out. And now they're at 850,000 barrels a day. So they've already increased 400,000 based on what we're seeing here. And they're pretty much in line to hit about 1 million barrels within the next 2 weeks. So it just gives you an idea of the sheer size in which that they were going to reach. And then obviously Iraq continued to surprise to the upside, coming at 3.87. Again, well above where they were supposed to be, because they do have cuts to make up, but instead of making them up, they actually increased. Nigeria is slowing down a little bit, and this is more just because there's deferrals out of November into December. So the loading schedule has gotten shifted just because they're seeing a bit more storage. Angola is the one that has seen a fairly stable flow in terms of their demand into China. Nigeria is the one that's seeing the increased pain. The question is going to be now, what is the decision made as we go into the January, when OPEC was supposed to increase production by, or based on the OPEC Plus agreement, increase production by 2 million barrels? Well, we have Libya that is coming back about 900 to 1 million barrels more than expected. And we have new COVID cases. We have new lockdowns. We have a decline of the, early estimates are a decline in Europe of about, let's call it 1.5 to 2 million barrels a day. which is essentially all of what was supposed to come on. So why would you increase your flow knowing that this pain is coming, especially as we have a decline in industrial activity, a decline in global trade, some additional pressures coming in. So it is likely that we will either see no action, which just means that they won't increase for at least 3 months by 2 million barrels. And we could actually even see an additional cut of anywhere from 500,000 to 1 million barrels a day, which would most likely be carried by the GCC countries, being Saudi Arabia, UAE, and Kuwait, as well as Russia. Now, the question is, will Russia go along with this? They've been cheating anyway, so they can say yes and then just cheat. So that's one where when we look at Euro pricing, Euro prices continue to struggle as we have Libya coming back. And just as we've been talking about consistently and constantly, and I apologize for it, is that Europe's demand has been falling with the renewed issues overall. So when we think about Europe, and this is where it gets interesting when we start to consider, well, what's happening in Europe? This gives you a little bit of a backdrop of, the unemployed since the onset of the pandemic. And now, mind you, this was finished in July. So I have the report. And just to give you a concept of, okay, this was when we came out of lockdowns and now we're back into lockdowns. So keep that in mind as we start to go through some of the data points. And the people who became unemployed, you can see that it was pretty well split with across the board. But the 18 to 34 saw the biggest increase, which is going to be a problem. And obviously the self-employed saw a bigger increase, secondary lower education, and just in total. So across the European Union, we saw about 8.5% of the people become unemployed. And that's something that's going to continue just based on, the renewed issues, the slowdowns in manufacturing, the issues that remain in services, which is going to be a problem as we look out at how quickly can Europe get back, which is why in the very first segment we showed those headwinds and the really depressed slope trying to get back to normal that really spans over the next few years. And this is really kind of showing because they were already struggling. They were already slowing in 2019. So 2020, again, COVID was just that jet fuel on a forest fire, which is going to be a problem as we continue through the remainder of the year. Now, this just gives the backdrop based on location. So obviously different countries are going to be better and others worse. Germany's one of the better in terms of what the likelihood of losing one's job was in the next 3 months. This is looking at July versus April. April being when there had lockdowns and people, saw or thought that they were going to lose their jobs. July is where, and now you can see why when we look at November will be something a little bit worse. Just because, will it be as bad as April? No, because the buy-ins are different in the sense of people may not listen to the lockdowns. You had buy-in. You had people in February, March, April saying, this is what we have to do. Now that we're on the other side of it, we're seeing that it's not as deadly. Once we've changed the way we treat it, people will not see the same type of buy-in, which again is going to we're going to fall somewhere in the middle where it won't be as bad as April in terms of the expectations of losing a job. Won't be as good as July because now we have a double dip in terms of that recessionary backdrop, which just means that, it's going to, I would say, split the middle. And that's going to just be that overarching headwind as we look at employment, as we look at the consumer and spending overall, which is going to be depressed across the board. And now last backdrop on this is just looking at the change in working hours. And here you can see that they decreased a lot across the board, decreased a little. And again, coming back to what are we going to see now? We're going to see that increase again, just because, again, lockdowns just mean that you have curfews, you have restrictions, which is just going to see this increase. So again, coming to tax revenue, coming to revenue in general at the business level, which is why we talked about the ECB being more supportive with some of their bond purchasing and trying to get the governments and get them the ability to stimulate. This is that really kind of that backdrop in terms of where we sit. This was just an interesting chart. There's been a lot of them looking at some different levels when we start talking about stagnation, stagflation, deflation, inflation. This is just looking at the Dow Jones. Again, not the best metric, given the fact that the S&P is can't stop, won't stop. This just puts it into context versus the 1930s, because people that know me know that I've been saying that we're coming into a point that is very similar to the 1930s from a generational level, from a nationalistic level, from a generational cycles level, from just this euphoria that is coming to, just as economies weaken. Again, COVID just happened to come at the time that it did, but we also had climate change that has been driving droughts, flooding, all of these shifts in just food security. GDP growth isn't perpetual, even though others would like you to think it is. And this is why it's an interesting backdrop in terms of, are we going to follow a similar path? And this is, I have other charts like this. If you find this interesting, sometimes I like to just look to see, well, where have we been previously? Are we going to see something similar? And, that we're getting a bit more and more like that. And the question is going to be, how quickly do we get fiscal stimulus? Because we also learn, and we learned from what happened during the Depression, and we'll try to do things a little differently to stimulate. But again, nationalism has been rising. That nationalistic fervor, the trying to protect one's own versus opening up has been increasing, even though we know it made things worse when we look at Hoover and then again with FDR. But we do need infrastructure spending. We do need some sort of stimulus. Again, why with our private equity fund, we're trying to focus on energy infrastructure, because shockingly, we need a lot of energy infrastructure at this point, and it's a good way to get those jobs going, especially if we can get some partnerships with governments. So when we think about central banks and what they're willing or able to do, and next week we're going to talk more about Australia and some of the issues that have been happening overall as we start to look at this more on a policy basis, as we get some more clarity as to the U.S. election. But central banks became net sellers of gold for the first time in a decade. Now, you may say, Mark, how can you be bullish gold if they're selling gold? And it's because they're looking to do it to bring dollars forward. And what does that mean? That means that their FX reserves have started to dwindle, and you can only sell so many of your treasuries without losing future revenue, because if you sell the treasury, you're pulling the principal forward and you're not going to get those interest payments. But now it comes to, they need cash fast. And how do you get cash fast but sell it into a very liquid market, which is the gold market? So instead of being that net buyer, they are now net sellers. And again, this gives me more concern on the global market, because it means that they're willing to liquidate, obviously, an asset they've been accumulating since 2011 in order to create some semblance of security, because stimulating the economy is dangerous. You risk inflation, especially at emerging markets. You risk losing confidence in your currencies. We've seen that in the ruble. We've seen that in the lira. We've seen that in the rupee. These are things we've seen it in the Brazilian real. So what do? You sell gold to show a stronger FX reserve in dollars. And you can say, look, I need to protect my peg if you have one, or I need to show more dollars to show that you can trust my currency and I'm going to do the right thing, because people don't appreciate gold in the way that it is when it's shown on the central bank balance sheet. They want to see it converted, which again pushed gold down. Now that it's obviously rebounding as we head into a very interesting Fed conversation, which is just going to be dovish, so no surprise there. But it's just something to watch, because as this accelerates, I think it's going to accelerate if currencies weaken, and if currencies are weakening, there's a reason for it, which means that there's going to be more pressure, which is why we did the Mediterranean conflict show, because again, this is something to watch as we have to consider where is that first shoe going to fall when we're looking at security and kind of maintaining some of the integrity in the global market, because we remain net bearish the global economy. And this is kind of telling you that central banks agree. Now, when we look at the gold demand kind of trailing off and we look at the appetite, so clearly, obviously, central banks were the net sellers after being years of buyers. The one thing that we've seen is obviously jewelry slows down. Jewelry usually picks up in Q3 and Q4 as we have marriages in India picking up, and typically they're a big buyer on the jewelry front. ETFs remain robust. Bars and coins, same thing. Technology, same thing. But you can see kind of it's been fairly stable. Then the biggest flip is just looking at central banks. Central banks flip to the downside, and that's going to be something to watch. The other one to watch is going to be not only central banks but ETFs. Where are people liquidating their ETFs to essentially bring cash in? Because a gold ETF is very liquid, very easy to trade, and at the same time, if you need to meet margin calls, you're going to sell gold because, one, it's liquid, it's easy, and it pulls in a decent value just given where it is on a pricing metric. So again, ETFs and central banks will be the ones to watch when we're thinking about fear, because as people get margin calls, it means something much bigger. It means that they're on the wrong side of the trade. So they will sell gold to meet margin calls, but they're also going to pare back risk, which is going to be something that could be a net headwind. Now, when we look at semiconductors, because it's one thing when we're talking about gold into technology, and I think it's important to talk about where is semiconductors happening, how is this shifting overall, because this is looking at industry as an aggregate. South Korea remains the largest capacity by country, and this is bridging us a little bit into the conversation we're going to have next week, looking at China, looking at trade, looking at Australia, because China is looking to increase that exponentially, and they've given a significant amount of cash to that. We're going to do a whole segment on the 5-year plan. Now that the planetary Congress has happened, we want to look at what does that mean going forward, and they're looking at this and saying that they want China to be number one. And do they take Taiwan to make that happen? That's something that we'll discuss. But the question is, China wants to grow regardless, and they've seen an increase in investment along those lines. The U.S., Japan, Taiwan, South Korea, nothing's surprising there. But again, this is going to be something to watch as we look at government planning, country planning on the next 5 years, because the U.S. also wants to increase their abilities to manufacture at home, and there's something to be said about kind of what that looks like, and Taiwan has been a big part of that. But we also have an increase in the amount of facilities being purchased and built in Vietnam. So how much of this is going to be China, people leaving China to build in Vietnam versus China building themselves to try to backstop and try to become more self-sufficient? As we see Huawei, additional actions against Huawei and other Chinese firms see additional sanctions and other types of issues, which is going to be a problem overall. Now, we've shown this before. We just want to look at it again, just looking at working hours lost. And the reason why we're showing this is because there's an increase in overall working hours. It's important because the renewed lockdowns, you have to appreciate kind of where we were, hours lost % average over Q1 and Q3. So when we look at Europe and Central Asia, you can see that the stimulus obviously didn't match the hours, and the hours are increasing again with renewed lockdowns, which, as we've seen in the US as well, we have hours worked going down. And the Americas and Europe are the hours lost as a % is going to get worse in Q4. Q3 they slowed, Q4 they're going to pick up, which means coming to the fiscal stimulus and what the value is. So obviously the ECB has done more. We expect the US government to do more, and that's why as we go into the Fed day, we expect to see an additional dovish stance to provide some of that backdrop to make up for those hours lost, which we think will accelerate through the end of the year and also continue to be a problem as we head into 2021. So that's all we have for you. Obviously, these shows are a little bit longer. There's a lot to cover in the economy just because it's a global beast and it's interconnected in very unique and fun ways. So thanks again for watching. Please subscribe, share, leave us some comments if you have any. And we appreciate the support. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.